Namaskar and welcome to Public Forum. I am Charu Karthikeya. Our debate in this edition is about the microfinance sector in India. The Reserve Bank of India in October last year had set up a subcommittee of its Central Board of Directors to study the issues and concerns of the microfinance sector in India. So the committee recently came out with its report and its findings, its various recommendations. So in the next 60 minutes, with the help of a panel of experts, I'll be trying to decode the findings of the Malligam committee and what do they mean for the microfinance sector in India. And joining me in the debate in this edition of Public Forum is an extremely distinguished panel of experts. On my extreme left, Mr. Sanjeev Shankaran, Deputy Chief of Bureau with the Mint. Next to him, Dr. Sunita Sharma, Chairperson of Sulakshmi Finance, which is a non-banking finance corporation. And right here with me, Professor B. Bhattacharya, noted economist and former Vice Chancellor of Jawaharlal Nehru University. Welcome to Public Forum, three of you. But before beginning the discussion, take a look at our special report.
On October 2010, RBI constituted Malligam Committee to look into microfinance sector. YH Malligam Committee submitted its report on January 19, 2011. Malligam Committee constituted after turmoil in Andhra Pradesh's microfinance sector. More than 80 people committed suicide in Andhra due to coercive methods adopted by MFIs to recover loans. Malligam panel proposed 24% cap on interest rate on MFI loans. Average margin cap of 10% for MFIs with a loan portfolio of Rs 100 crore and of 12% for smaller MFIs recommended. Microfinance institutions extend loans in rural areas, mainly unbanked areas. Malligam Committee suggested creating a new category of NBFCs for MFIs. Committee recommends variation in tenure of loans and commencement recovery to mitigate problems like multiple lending, over-borrowing and coercive recovery. At most, 2 MFIs should lend to a single borrower. A minimum period between loan disbursement and repayment recommended. Lender and its management will bear primary responsibility for avoiding coercive recovery methods. MFIs will be allowed to levy only 3 charges: processing fee, interest and insurance charge. NBFC MFIs should be exempted from State Money Lending Acts, says the committee. As per the committee report, RBI must prepare a draft customer protection code. Committee recommended setting up 1 or more credit information bureaus. Recommendations must be accepted and implemented by 1st April 2011. Regulations of MFIs should be done by NABARD in close coordination with RBI. All MFIs would have to observe a specified code of corporate governance. With an estimated 22,500 crore rupees lent to nearly 2.7 crore borrowers, MFIs have become a mainstream financial activity. Centre has drafted Microfinance Bill for regulating MFIs. Microfinance Development and Regulation Bill 2010 likely to be introduced in budget session. Bureau Report.
Okay, so let's begin the discussion now. Sanjeev, I would like to begin with you. Code of corporate governance, cap on interest rates, regulation. The report talks about a lot of things. The Economic Times verdict on the report is it's a brave but messy report. What's your verdict?
It's disappointing, primarily because I think the report tends to, or the recommendations are such that they tend to micromanage in a way that may be very difficult for a regulator to enforce. And one of the unintended consequences of the recommendations could be that it stifles competition in some way. And within the microfinance industry, what we've found is that competition generally tends to bring down rates, very slowly perhaps, but they do bring down the rates rather than any other way. And on the question of capping rates and so on, I really wonder what the committee was thinking of, because we're moving to a stage where we are trying to get away with, get rid of these artificial barriers because they haven't worked very well in the past. Okay. So on the whole, it's a very disappointing effort.
Okay, so in one word, it's a disappointing report. There's a lot of micromanaging that the report is probably hinting towards. Dr. Sharma, I would like to know your opinion.
Yeah, actually, I think they are seeing this is the surface of poor people around 70% population of India, and the regulator are seeing like this. I think the scene should be like this. People are seeing you in a manner that please come with welfare activities or welfare policies, etc. But what is happening is they are regulating their poverty, how to remain poor all the time. Suppose I am a poor man and I do not have sufficient income, and you are embossing on my forehead that you are born poor and you are going to die poor, because they are sealing my credit limit and they are sealing my lenders, each and everything. They are sealing my income, my borrowing capacities, plus how to spend this money. Each and everything is being regulated by a person who is actually not a poor, who do not know what poverty is, who has never felt this poverty, the pain of being a poor. So I think if we see the angle of a poor, it's not a good for the real poor man.
Okay, so in the long run, it won't really benefit the poor borrowers whom the microfinance sector really caters to.
You can say Raksha mein hatya. Yeah, you are killing in the name of safety.
Okay, killing in the name of protecting the poor. Professor Bhattacharya, your opinion?
I think we have to see it in a more broader perspective. A recent report by Raghuram Rajan, the distinguished professor of finance of Chicago Business School, pointed out 85 to 90% of the rural finance and even as high as 45% of the urban finance are outside the purview of institutional finance in India. Small and informal sector is totally excluded. For the reasons easy to understand, the large scale sector, organized financial sector don't want to enter because there is too much risk. This small and informal sector is also politically very vulnerable and sensible. No government report, in my opinion, can say have it free. You can say liberalization of the large industry. Even commercial banks with so much of talks of liberalization have not gone full hog on liberalization. In fact, we are talking about virtue of keeping them some control. Because of this, we saved the global economic crisis. So this particular report, as you have already pointed out, derived in the context of the Andhra, I did not expect that it will be saying, let's open it completely. That will be not possible. In some sense, we should ask the question, what happens supposing if the rural and small informal sector is completely exposed? That was the money lending business earlier. Did money lending help the economy? No. So you need institutional finance. Institutional finance can come only through some regulation, some safety. We have seen the experience of commercial bank lending unregulated way to the rural and burning their fingers in it. Now you need a via media intermediate. You have to provide some fund to them. You also have to ensure the sector, neither charges usury capital because of scarcity, nor it dies itself. So I think Maligram Committee tried, within their own wisdom, a via media, certain cap on interest rate, at the same time saying that look here, there should be a regulation. And they're also saying the commercial bank can lend to them through priority sector lending. So accessibility of the capital. The only problem I feel is it is saying regulation should be done by the Reserve Bank of India. Reserve Bank is not empowered for micro regulation. It is designed to be central banking at the macro level. So burdening it with the micro regulation, I think it will be totally, confusing the whole issue.
Okay, so for you, in some respects, the Maligram Committee's understanding of the sector is deficient and the recommendations that it provides. Sanjeev, let's take these things one by one. One of the first things that the report talks about is we know that the largest number of institutions working in this sector, they are broadly NBFCs regulated by RBI, but institutions which are actually working as MFIs, there is no proper regulation of those institutions. So it talks about creating a new category of NBFCs which will be called NBFC MFIs. How do you look at this recommendation?
So I wouldn't say it's entirely accurate to say they were not regulated. NBFCs provided the bulk of microfinance loans. They are regulated by RBI. Yes, they did not have perhaps some kind of special regulation just for NBFCs
MFI.
operating as microfinance institutions. Now, when you look at some of the, I'm all for the regulation that he suggested, saying that let's have a separate segment within the NBFC category, saying NBFC, MFIs.
So that's good. A new
I'm
separate
okay.
category, a new category is good.
That's fine. I think they need to be treated a little differently. I think that makes sense.
Okay, Dr. Sharma, do we need a separate category of institutions which should be labelled as NBFC MFI, so there is better regulation?
Yeah, I think if they are coming into the priority sector, therefore there is, I think it is okay if they are specially categorized. But the thing, this minimum capital, this 15 crores is too high, na? It should be at lower side.
Okay.
Actually, right now it is 2 crores only, and going to 15 crores is too high, and I think the fate of so many MFIs will be in a question mark. Yeah.
Okay. Let me take a personal example from you.
Yeah.
Your organization is an NBFC. Would you want it to be classified or categorized as an NBFC MFI?
Yeah, I'm comfortable.
And you will have no problems with the
because my goal is very clear.
With the mechanism being provided by the
my goal is clear. I do not have any dilemma whether I have to go to other sectors for financing, to finance truck or home or cars, etc. So I do not have any confusion. I'm quite comfortable.
Okay. Professor Bhattacharya, this will be beneficial for the sector, but if there is a separate category where an institution is formally known as
very comfortable for that. The reason is you must allow these institutions to make some profit somewhere.
Yeah.
So that they can take care of the social responsibilities.
Okay.
If you are tightening them completely, that they must lend only 90% to the the income generation of the kind of people not more than 50,000 rupees annual income, I think you will be narrowing their activity, which in my opinion might be self-defeating. I would rather urge a model that let them make, say, 20-30% of them making profit wherever they can.
Okay.
So that total balance sheets of these NBFCs, they will not be all in the red.
Yeah.
If you tighten their hand too much, they will certainly do some kind of artificial.
Okay. There has to be some incentive for them to work as a social entity. Well, it's time for me to slip into a break. When we come back, the discussion continues. There are a lot of other recommendations that the Maligram Committee has made. For example, making lending to this sector a priority sector lending. How will that impact this sector? I'll try to find out in the next.